The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, in Sydney is the senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are things?
Very good, James. Yes, it's been a big week at the Financial Review. Our editor, Paul Bailey's leaving, and I think the general mood is that this is a bit of a sad time. He's been a very, very good editor for 11 years, so we're going to miss him.
Yes, and we welcome a new editor, Fiona Buffini, who's going to be absolutely fabulous as well. So that's exciting. But let's jump into what we're going to do this week. We're going to look at how much further the RBA has to go with its rate rise cycle. We're going to look at two billionaire energy plays, and we'll look ahead to what is a big week for Australia's banks. But first, Tony, I want to come back to a story that we looked at in detail a few weeks ago, and that was the collapse of the project to replace the ASX's clearing and settlement system, which is known as CHESS. Now, just as a reminder, this is an essential piece of the plumbing of financial markets. Every trade that gets processed needs to go through this CHESS system, so it's hugely important. Now, you might remember the ASX spent 7 years trying to replace CHESS with a whiz-bang blockchain-based system before they told us about 2 weeks ago, oops, that's not going to work. Now, Tony, there's been a few developments this week, and the first one of those happened on Monday, where we had the ASX chairman Damien Roche and CEO Helen Lofthouse in front of a parliamentary committee to explain themselves, I guess. We both listened to this, and I didn't think it went too well for them. How did you react to their performance, Tony?
Yeah, I agree, James. I don't think it went well for them at all. And the main reason was that I don't think they were properly prepared. And they were also hit by, I suppose you'd call it a tag team sort of series of questions from Senators
Yes.
Paul Scar and Deborah O'Neill. Now, these guys come from different sides of the political fence, but they were united in wanting to get answers to what's been going on at the ASX with this project, which they said as recently as July that it was on track. So I think the senators really did their homework, and that hasn't really been a feature of some parliamentary committees questioning people in business, but these two really had, and I think what came out of it was I don't think the board of ASX really understands what situation they're in or where they're going to go next. I mean, do you have confidence, having listened to that whatever they're doing at their board meeting in Sydney on Friday is going to result in something productive happening soon? Or
No, I don't think it's possible to have confidence in that at the moment. What surprised me, and obviously we've done a lot of these inquiries with the Royal Commission and the inquiries into the casinos, there was a bit of a lack of accountability that they sort of said sorry, but they didn't really know what they were saying sorry for, which surprised me. You know, that they claimed they'd been transparent the whole way through. They claimed that their risk management culture was okay, but I mean, the abandonment of the project says something's gone wrong, but they weren't able to nail it. I think that's the stage we're in at the moment, Tony. They're just trying to nail what's actually happened here and how they fix it. I mean, it's one thing for you and I not to have much confidence, but it was very noticeable. Sitting in the front row as Lofthouse and Roche gave their evidence was Joe Longo, the boss of ASIC, and he fronted the committee on the same day a few hours later. Now, this is one seriously peeved regulator, Tony.
Yeah, look, I don't think anyone in any industry wants to get offside with their regulator, and definitely ASX has done that. The clear message from Joe Longo later in the afternoon when he gave his testimony to the committee was that he wants more powers. He wants to be able to direct the ASX to do things. He says his powers are limited in terms of either dumping their licence or nothing else. So he needs a greater degree of flexibility in how he can deal with that. I think the problem for Chairman Longo was that he went on board with what the ASX was telling him and actually told this same committee earlier in the year that the software was built, and we later discovered that only 67% of it was built. So that's a pretty big shortfall. So, look, I don't know where that'll end up, but hopefully there'll be greater involvement in this whole piece of infrastructure in Australia by, the Treasurer as well, Jim Chalmers.
Yeah, it's on the top of the agenda. There was another piece of this puzzle online on Thursday and in the paper on Friday, and that was a story that you and James Ayres, our Gun Fin Services reporter, broke around the company that ASX has been working with to build this chest replacement system, a New York-based company called Digital Asset Holdings, and they're not exactly sticking up for their customer here, are they?
No, it must be tricky to manage that relationship at the moment, especially when the ASX CEO, Helen Lofthouse, threw them under the bus on Monday by saying that the escalating delays in the program were due to digital assets, which of course came back and said the delays have not been due to digital assets. It's not their fault. So that sort of puts it back onto the ASX. I suppose digital assets would hope that they would continue to be involved in whatever comes next. And we're certainly getting that message from Tim Hogben, who was head of the chest replacement project, told the ASX Business Committee this week that he thinks that there's coding can be salvaged from what they've done, which sits a bit oddly with the fact they've written it all off. So anyway, look, do you think that we're really probably now looking at another 2 to 3 to 4 years for this to be completed, aren't we? Or?
I think so. And there was a bit of pressure on Lofthouse in the hearings with the senators saying, well, you need to get onto this really quickly. And she was sort of pushing back. And I had a bit of sympathy for this view that she was saying, hang on, we don't want to rush this and make the same mistakes all again of getting the scope wrong, getting the design of the project wrong. We need to take our time here. I think that's right. I mean, hopefully they can keep the current chess system up and running for another 3, 4, 5, it might be longer than that, years. But I think you're right. We're a long way from the chess replacement, aren't we?
Yeah, well, I had the privilege of being the IT editor of the Financial Review probably about 20 years ago now. And one thing I learned was the definition of a legacy system. It's one that works. And so that's yes. What the current chess is. It works. So if they can do this new thing in parallel, which obviously will cost more money, then that's probably going to be good for Australia to replace it without any impact upon the financial system.
Yeah, fair enough. All right, Tony, well, let's jump to our first big topic of the week, and that's the RBA's latest rate rise. Now, they did exactly as everybody expected. They increased rates by 0.25% to 3.1% on Tuesday. But just because it was expected doesn't mean it didn't hurt. And I reckon this one actually seems to hurt a bit more. I was listening to some talk back on Tuesday, a bit of the Great Australian Barometer, and geez, there's some annoyed people out there, and they don't quite understand why the RBA has to keep doing this. So I don't think perhaps the bank hasn't explained that nexus between inflation and rates just as well. But monthly mortgage payments just keep going up. So if you're a variable rate borrower with a $500,000 mortgage, which is roughly the Australian average, that mortgage is now going to cost you an extra $74 a month as a result of this rate rise. And you're going to be paying $3,169 a month now. And that's increased 37% since the start of May when the RBA started lifting rates. Tony, what's driving the RBA's thinking here? Why are they keeping the pressure on given how much heavy lifting they've done across the course of this year?
Well, I think the data keeps coming out showing that households are still very active and driving a lot of activity in the economy that potentially is pushing up prices. As we know, inflation is a terrible scourge on any economy. And as the Governor, Philip Lowe, said early this week in his statement following the rate rise, it really makes life difficult for more and more people if it's allowed to get out of control. So they actually said in that statement that inflation would hit 8% by the end of this year. That is very, very high. It's not. It's double the level of any wage rises I've seen. So yeah. But they want to get it back down to about 3% within 2 years. I mean, do you think that Governor Philip Lowe has got the right strategy? I mean, it is true, isn't it? Inflation has actually caused a lot of harm to many economies over the years.
Yeah, I mean, I don't see what else he can do really. I think the pain he's causing here, the pain he's caused with interest rate rises hasn't hit household budgets yet. And I think that's coming. Tim Toohey from Yarra Capital Management, an economist who's been around a long time, he says that the combination of higher interest rates, higher energy costs, and higher insurance premiums, which if you've opened a utilities bill or an insurance bill recently, you'll know all about that. He reckons that's going to see average household discretionary cash flow fall by about 15% in the middle of next year. And that's a fair whack. He reckons we'll see 0% growth on retail sales in 2023. So the hit is coming, and that should help bring inflation down. But really, Lowe's going to have to continue to keep the pressure on. And that was the message in the statement on Tuesday, that the RBA is not done. So that's a worry if you're running the household budget. And I guess that this is all happening, Tony, against the backdrop of this RBA review. Phil Lowe's contract is up for renewal next year. How does this turn out? Do you think the governor of the RBA's job's in any danger, or will it probably end up, finding that, okay, they need to change their communications message a bit, but he can keep his job?
Well, I think we probably have to separate two things. One is Governor Philip Lowe being a good governor, and does he deserve another term, having already been there for 7 years? And by the way, his term expires in September. I think we should separate that from the RBA review, which is about the inflation targeting, monetary tools, board structure, accountability, the culture of the whole organisation. I'm not sure that all can be sheeted home directly to him. My understanding is that, he's pretty ambivalent. He's a very keen golfer, and I believe that, if his term is not renewed, you'll just find him out on the course a lot more, and he'll just enjoy life. So I don't think that's, he's craving to hold on to the job, but obviously if they ask him to stay, I'm sure he would. But I think it's probably likely they will change. I mean, do you feel as though he's deserves another term?
Oh, look, I don't think he's been necessarily a bad governor. Getting the economy through the pandemic, I think they did a pretty good job there. They reacted quickly and, quite transparently. But I guess his communication's been pretty poor in the last year or so. I mean, the whole thing about basically suggesting interest rates wouldn't rise until 2024, that looks an error in hindsight, obviously. And then I thought his apology for that was a bit of a Clayton's apology, saying, I'm sorry if you listen to me, is a bit, we're supposed to listen to you. You want us to listen to you. That's how you control the economy, or help control the economy. So I don't know. I think a lot will depend on the review. What sort of organisation has he overseen? Perhaps those communications issues are less of a deciding factor than how's the mechanics of the RBA worked. But Tony, how much further do you think the RBA has to go here? We've gone from 0.1% in the official cash rate in April. We're now at 3.1%. Where do you think the terminal rate, what's the peak rate next year?
Well, I think it's 3.6%. I think another two rate rises of 25 basis points in February and March. There'll be a really critical CPI figure on the 25th of January when everyone's on holidays, and that one will probably include a lot of these higher energy prices. So if that comes in well above expectations, there could be a lot of discussion about the February meeting and whether they go more than 25 basis points then. But that's my sort of thoughts on it. But I know there are others out there like Andrew Boak at Goldman Sachs, who thinks it'll be more like 4.2%, which is a lot higher than 3.6. So either way, I just hope we get to a soft landing. What's your call on this one?
Yeah, I'm 3.85%, so another 3 rises next year. I think what concerns me a bit is, we had a lunch this week with the CEO of one of the big 4 banks, and he was saying we're putting through wage increases of 5% to 10%, and that's indicative of broadly what he's seeing across the economy. I think those wages will continue to push up inflation to a level that the RBA finds uncomfortable, and they'll have to do a little bit more than they might otherwise want. But I guess the other question maybe, Tony, is where's Phil Lowe's golf handicap going to get to? You got an answer on that one for us?
Well, all I can hope is that his putts don't come up as short as his expectations.
Very nicely done. All right, we're going to move on to our second big topic of the week, and that's energy. Friday afternoon is going to see the National Cabinet talking about price caps on gas and coal. But meanwhile, we've seen two billionaires take centre stage this week. Gina Rinehart, who's the owner of Hancock Prospecting, she's trying to buy a gas company called Warrego Energy. And then we've got Andrew Forrest. Now, he's both the executive chairman of Fortescue Industries and has his own huge private interests. He's spending $4 billion on a company called CWP Renewables, which is a huge deal. Tony, what's he getting for his money here?
Well, he's buying Australia's biggest renewables energy operator with about 2.4 gigawatts of wind, solar and firming projects. And it's also got a very big pipeline, about 5.5 gigawatts of medium-term renewable generation that is going to be built by them. It's a huge deal. I mean, the company's only got about 80 staff, which shows you how efficient these big renewables companies are. And it's got a pretty impressive board. The chairman is a former Origin CEO, Grant King. But you wrote a good column on this one, and I think you actually talked to the great man Andrew Forrest himself, didn't you?
Yes. Well, I think that's really interesting. Obviously, we sort of know Forrest best from this big green hydrogen push that he's making through Fortescue Metals Group. So, he wants to get green hydrogen going throughout the industrialized world and try and use that to bring down heavy industries' carbon emissions, which is great, sort of good plan. But it's a plan that's a fair way off. It's probably 10 to 15 years away from commercial scale. So what's interesting to me about this is that now Forrest is in the middle of the energy transition with this deal. He is now the biggest owner and operator of renewables in the country. He's got, as you said, a 5 gigawatt medium-term pipeline and a 20 gigawatt long-term pipeline to develop. So if we're going to get coal out of the national electricity market, it's currently about 60% of the electricity market, we're going to need a lot of these projects. So that puts Forrest really at the centre of this big transition. We're not going to be able to do it without him and his assets. So I think that's fascinating. And Tony, it speaks to the role of private capital. You've talked about this before. It's hard for a publicly listed company or even a government to do this. We're increasingly seeing, whether it's billionaires or big private investors like Brookfield, leading the way here. Why is that?
Well, yes, they're not answerable to stock markets on a day-to-day basis, although you've got to remember we have a very low cost of capital relative to the rest of the world thanks to dividend imputation. So I think a lot of the energy transition probably will be financed through publicly listed companies because those dividend imputation features have, lowered basically the cost of raising money. But as far as these big private owners and billionaires, they're just so fleet-footed and flexible. And this was a process, this CWP Renewables, that we thought was going down the traditional road of big companies spending, putting all their bureaucratic might into trying to negotiate this thing. And then just Andrew Forrest swooped in. He's got a deal maker there named Alexander Jury, who's ex-AGL, and backed up by John Hartman, who runs Tatarang. And then it was just amazing. The scoop turned up in Street Talk, and everyone was just shocked that they'd actually gone and spent $4 billion without everybody even knowing they were in the data room. Of course, I think it's half of that is debt, so it's not a big an equity check as you would expect, but. The private money is becoming the key factor in Australia's energy transition.
Yeah. We should also say, Tony, these guys are having a bit of a bet each way, Gina Rinehart and Forrest. Obviously, their mines have emissions, and the steel makers that they sell their iron ore to, they have big emissions. And these guys are sort of investing in different ways. Both Rinehart and Forrest have gas investments, so they're playing that fossil fuel side of the energy transition, and then they're trying to play the other side. Forrest's got this renewables play, and then Gina's trying to go into things like copper, rare earths, lithium, all those things that we're going to need for the energy transition. So they're having this old-fashioned bet each way, aren't they?
Yeah, they are, and it's good to see that, I saw a report from Fitch, the credit rating agency, that Australia is actually making tremendous progress. Their database shows there's 52 green hydrogen projects, 22 of them totaling 37 gigawatts of capacity. So they're all scheduled for completion before 2030. So, there's a lot actually happening out there. We have a lot of scepticism, I think, in many quarters about whether Australia will get through this energy transition with the level of renewables that are in the pie chart that gets you to 43% reduction in emissions in Australia. But there's certainly a lot happening that is perhaps not immediately obvious to the skeptics.
Yeah. So last question for you, Tony. Back of the envelope figures, if Forrest's going to develop this 20 gigawatt pipeline, he's going to need somewhere around $35 billion. And Brookfield's talking about investing $30 billion over the next 7 years in renewables. How hard is it going to be to get all the capital we need for this transition? Do you think we can pull that off?
I think we can because of organisations like Macquarie Group. I mean, they are hunting around the world trying to find energy assets to invest in. They're constantly raising new infrastructure funds. And then I think of the personality himself. When you go back to the start of Fortescue Metals Group, taking on BHP and Rio Tinto, he basically just had to convince private capital in America, a company called Lucadia, and then he had to convince the big investment banks in America, and particularly JP Morgan, and they backed him all the way. And he basically just raised $14 billion in borrowings to get the thing done. And now here he is, the third biggest iron ore exporter in Australia. So you combine the demand for investment and the amount of money that's in the world to go into this with someone like his personality. I think, he certainly his organisation will get there. Whether the whole country does, I'm not, that's a bigger, harder question.
Yeah, it does feel like the capital's the bit in some ways it's going to be easiest. It's the approving these projects and getting them out of the ground and connecting them to the grid. That's all pretty complex, but there's plenty of money to finance this, which is good. Tony, speaking of money, we're going to come back after the break and look at two essential moments for next week. We've got the Federal Reserve's rate decision, and then the banks are in the spotlight again. Okay, Tony, well, the Reserve Bank of Australia was in the spotlight this week. Next week, it's the turn of the Federal Reserve in the United States. They're going to make their interest rate decisions. They actually get their latest inflation data on Wednesday night, and then Thursday night, Friday morning, our time, we'll have the latest Federal Reserve rate decision. I guess this is a pretty well flagged one too. We're expecting the official rate to go up by 50 basis points to around 4.5%. Federal Reserve Chairman Jerome Powell has basically locked that in. He's jawboned the market to expect that. You're not expecting any late surprise, are you, Tony?
No, I'm not, James. No, I think that's going to be the way it'll play out. I just keep looking down the track to that potential terminal rate. Where's the end game for them? And everyone seems to think it's 6.5%. So that's a pretty staggering number. Another 2% of increases in interest rates in America. That hasn't been seen since 2000. And that's going to have a big impact on the American economy.
Yeah, Jerome Powell he'd love to see a little bit of softness in those inflation numbers this week. That'd be the Christmas miracle he's after, but I don't know what we're going to see. So there's some stubborn inflationary pressures, particularly around rent and things like that in America. So we'll wait and have a look there. The three banks, Westpac, NAB and ANZ, have their annual general meetings to end next week, 3 days in a row. Too much banking's never enough, Tony. What are you expecting here? I mean, there's no great sort of pay fights, but climate change is often an issue at these meetings. Do you expect that to be the case this time around?
Yes, I think that'll be the case again. There's no letting up on the pressure on the banks to stop lending to fossil fuels, and they keep resisting that. So then they're not going to get rid of existing clients, and they'll play that out. And that's a feature of every bank annual meeting, isn't it? So I suppose what I'll also be looking at is just the commentary from the CEOs and the chairman about what they think is happening in the economy and how we're travelling. So they've sort of got their fingers on the pulse, haven't they, the banks? So.
They do. But they're in for a pretty good 6 months. I mean, these rising interest rates are good for their profits, and so they'll have to strike that balance of saying, "Oh, we're worried about the economy," and then sort of saying out of the side of their mouth, "But gee, it's going to be a pretty good pretty profitable next 6 months for us." So that's a balance they'll need to get right. Tony, another really fascinating data point for us down here is employment numbers, which come out on Wednesday. Unemployment sits at 3.4% at the moment. The consensus is that it falls to 3.3% next week. These are extraordinarily low figures. Do you have a sense of how low unemployment could go?
No, I mean it gets amazing. I mean, this is the lowest rate since 1974, which is the year before I left school. I mean, the job vacancies are everywhere. There's employment growth is certainly slowed recently. But one little anecdote I picked up during the week when I spoke to the CEO of a big systems integrator, he'd done some analysis. If all of the IT transformations in Australian business are going to go ahead and be achieved over the next 5 years, he reckons we're going to need 300,000 technology workers. I mean, this is enormous. It's such a huge figure, James. And then in the next breath, he told me that they've got applications in with the government for visas, and they're taking 5 months. So I think someone in Canberra needs to be in the immigration department needs to be getting some work done on that. Maybe even some streamlining of their processes. Because a lot of those things are, you're repeating the same. If you go and apply for a passport, you're repeating a lot of the same information on different forms on the way through. So, the unemployment rate certainly is very low, but there's still a huge shortage of workers.
Yeah, and that's going to be another factor for Phil Lowe to consider as he tries to get inflation down. Is that really tight labour market going to make his life harder? Well, Tony, we love getting questions from our audience, and you can send your question to chanticleer@afr.com. This week, we've got a puzzler from James Rawlings of Canberra, who says he loves the podcast and the fact Tony shares the good, bad and ugly of his Chook Super Fund. Just wanted to know what you both think about nuclear energy kicking off in Australia. Will it ever happen? All the best for the silly season. Now, Tony, this has been a perennial... and it's certainly coming up a lot this year. Is there room for nuclear energy to make some sort of contribution to the energy transition?
Well, I'd start with memories of, I didn't actually see him doing this, but Anthony Albanese, the Prime Minister, was, as a uni student, participated in anti-nuclear marches. So that's sort of like the political starting point for this. I know the former Energy Minister, Angus Taylor, was a big supporter of nuclear energy. I don't think Chris Bowen is. So that's the first thing. I think we're going to need bipartisan support, and I can't see that happening at the time being. The other thing is it really needs the support of governments in New South Wales, Victoria and Queensland, where 90% of the population lives. I know the Premier of South Australia, Peter Malinakis, has put his hand up and said he supports nuclear power. But I think it's really those big states on the eastern seaboard that will decide this matter. And with 2 Labor governments and potentially a third one, with an election in March in New South Wales, I can't see it happening. What do you reckon?
Yeah, I think that another one of the big hurdles is a practical one. From what I understand in other countries, particularly America, a lot of the skills and expertise for the nuclear sector come from the military, where there's nuclear submarines and other other kit that helps sort of cross-pollinate across the power sector and the military sector. We don't have anything like that, so we're not going to have the skills and capabilities and resources to develop a sort of homegrown nuclear sector. And I think that and the cost of even these small module reactors is just going to be prohibitive. I think, our path lies in abundant renewable energy, firming to back that up, wind, solar firming, that sort of combination seems to be the way we can hit our targets faster than trying to develop these things over 10 or 20 years. I just think the boat's sailed. So be interesting. We'll see if anyone else has a go. I'm sure the issue won't completely go away. Tony, we always love to throw out a recommendation, and we're going to talk our own book here. I'm not sure if you've had a chance to listen to the fabulous episode of The Fin. Both of us have covered closely Magellan Financial Group, the big fund manager that was previously run by Hamish Douglass. And the rise and fall of Hamish Douglass and Magellan is covered in depth on this episode of The Fin by our gun markets editor, Vesna Polyak, John Shapiro, our Walkley Award-winning senior reporter, and Joe Aston, our Rear Window columnist. Tony, have you had a chance to listen to this one?
I have actually started to listen to it, and I agree it is a very good podcast because it goes into, I suppose, every aspect of the rise and fall of that organisation. I mean, it is not actually fallen completely out of, it's still a very big fund manager, and it has a plan to fix itself. But I think the strategy of the chairman, Hamish McLennan, enunciated last week is probably a good one if you can find more early asset management type companies to add to the Magellan stable and diversify its capacity to raise money, then that might actually work. But he's got a lot of work to do to fix that company.
The podcast even features lunch with Hamish Douglass at McDonald's, so that's something to look out for too. And Tony, we'll be back next week with a special guest to help us wrap up 2022 and look forward to 2023. So I can't wait for that.
Yes, I'm looking forward to that too, James. Obviously, we can't reveal who it is yet, but I think the listeners will really enjoy it.
Well, Tony, thank you. It's been another great week, and great to have your expertise on some of the big stories from this week.
And great to have yours, James. See you next week.
Terrific. Thank you to our listeners as well. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you could subscribe to The Financial Review at afr.com/subscribe.
The Australian Financial Review.